We'll just use modern day English. How about that? Okay, so now we understand what a trend is. So you have two things. You're either going to have expansion, like you would in the summer, everything expands when heat expands. You have expansion, or you have contraction. You have range contraction. Okay, when you have contraction, makes the market a little bit tougher if it's an extended or elongated contraction as opposed to a continuation. And I'm going to get into that in a moment. So, what is a range? A range, basically, you're establishing a high and you're establishing a low based on prior swings. Okay? You're establishing a range high and a range low, and the markets usually stay confined within those ranges, and they start developing this sort of like a sideways, what we call a sideways line, just like that, where you could take a line and draw it through all through the bars, and you could see how many times prices trade through that. And a lot of times when you get in this type of environment, it makes it very difficult for traders because you don't know. It looks as though it's going to break to the downside and shoots up. Then it looks real bullish and it's going to go to the moon, and then it fails back down. And it's the time that you see it come down here and you think, it's going to go up, and you buy it and it goes straight down. And we saw that happen the other day. I think it was Monday or Tuesday, where the market, it was Monday, where the market had been going a long time for weeks. And then suddenly on Monday, market went down. You could tell a lot of people decided they want to buy it, and it flushed with fierceness to the downside, and it, what we call, trapped a lot of people. And when it flushed everybody out and they got out, it ran them back up. So in a trading range, it can be a real roller coaster ride, and this is what it looks like. So that's called a trading range, and basically you get testing and you get price bar overlap. There's two types. For instance, here's what a range would look like where the market's doing this. Price bar overlap is after the market has made a rally, each price bar would start to establish a sideways consolidation period. And if it's a trend up, this is what we call that pullback, right? You would get these multiple bars overlapping, or what we call price bar overlap, or a flaggish pattern for continuation. That type of range is different than this type of range, as you see here. So I'm going to show you some, okay? I'm going to show you some examples. All right, where would we establish our range? All right, we could see right across here, here's a range high. We can see right across here, here's a range low. We can see right across here is a range low. And we also have some stuff up here. So when we start to look at this chart, this is the most difficult type of market to work with. And you see it just goes and extends over days, all right? And because it's erratic, the market doesn't know where it wants to go. It's basically just zipping around like a pinball in a machine, bouncing around with no particular direction. It's a directionless market, and when you have a directionless market, risk goes to the moon. And believe me, I've entered in and you get stopped out because it fakes you. It makes you feel as though it's going to trend down, it's going to break, and because it's still in a range, it snaps back. And every trader on the planet has to gets in this kind of range, and sometimes they get excited that they're going to buy it because it's breaking out, and it fails. And it's just a game. You don't know. Honestly, you don't know, but you can establish these range highs and lows, but you don't know the time when it's going to break out to the upside or break out to the downside, or it's going to fail. And that's the risk you have to take if you want to maybe take a trade. For instance, if the market came from this high straight down, it makes you feel that they're going down and they're going to continue lower, that they're forming a pattern for continuation. And what happens? It fails back up. This happens. So understanding what a range is, and that typically when you have a range, it's the most hardest trading environment, and that you want to identify this going forward in your own trading of, is the market in a range or is it in a trend? Typically, trends are the easiest and best ways to trade. A range is the most difficult. All right, all right. Here's another one. This one was on the 8th and 9th. Okay, you could see here. All right, so you're looking at the market and you're seeing this erraticness, and you're saying, how come you don't have any trades? You're saying to yourself, we all say that. There's nothing happening. Why? Where do you buy? Where do you sell? Do you sell here? Do you buy here? Do you sell here? It's just a spiky environment. As you can see, these little spikes, these are erratic movements in price, which really do not allow for profitability. It's the type of market, if you were to say you wanted to short it here because it's so fast, by the time you enter, it's here. By the time you look to get out, you're here. So this is a range, and I cannot stress it enough. You have trend and you have range. When markets contract, you have expansion and then you have contraction, okay? Markets end up doing this until they expand again, and then they contract and then expand. When you have this type of environment, just you have to be aware of that. So that's called a range. Now, this actually was part of a larger range up here, and you can see the market gave a nice shot to the upside, make it feel like it's going to the moon, and whoever bought it got stuck all the way back down, and whoever sold them got stuck on the way back up. So that's something to always pay attention to, what we call a trading range. This is an hourly chart of the S&P E-mini futures, and you can just see how the market acts in these tests. See these little tests? Okay, and that was actually that picture that I was just showing you, where it becomes erratic. It snaps out and then snaps back to the highs, and that's the type of market that you want to be aware of. A non-trending, rangy, spiky type of environment says to you either A, if you're going to buy and try to buy it here, you have to use a wide risk, or don't do anything, or if you're going to short them, you have to have a tight stop in case it snaps back up to you. All right, but most times you'll see a range have that price bar overlap, or that sideways line. So let me just show you. So if I take this line and come right across, you can see how many times the prices traded through it. All right. So that's a trading range. When you could take a line, stretch it right across your charts, and you could identify many different times over many different periods. Look at this. This is actually since December up until even yesterday, how far this market has gone. It's gone nowhere but sideways and trading through that one sideways line. That's a sideways line, just like that. All right. So that's a note you want to make. So if you ever hear the term sideways line, you know what it is. Now you know what a trend is, and now you know what a trading range is. See, in a trading range, there's no definition of direction. You could just see this. See, so you could not tell if this is going to be the low, if the low was here, if it was down here. There's no way to tell because the market's erratic. Think of it as a pinball. Okay. Okay. The next one we want to look at. I'm not going to make this a long webinar. I'm keeping this to the point, and that way we can establish our first little video and first webinar that's going to be the foundation for going forward. So a couple of things that are important, that are very, very important to technical analysis, is price relationships. What we call an A to B is equal to C to D. Now, on the website, there's a video I did. It's called Commonalities under the training section. And there's other complex stuff you can do with this, but just in its basic form of A to B equals C to D, I want to show you what it looks like. And this is what we call an alt. An alt A to B, C to D. All right. So what do we have? Let's just say A was at 100 and B is at 90. Or we could just say it's at 46 and 34, right? Hello. But let's just say that the market went up to 130, and this right here was 10 points. So this would tell you that this would be about 120 is an area that you would watch, that if the market came down and related in price here, that this would be an opportunity for you to trade. So when you're looking at the markets, we all have our demo platforms. You have the live educational room that we have up all day long. And for those of you that are in the live educational room, you get to see this stuff day in and day out, and you start to learn on your own and do your own trades. That's essentially what the goal is, to get you to start doing your own things and seeing this and making you a technician, where you basically, if you can understand this, you could feed yourself for a lifetime. I hope you understand that. So if you understand this, the basics, and you start to build upon that, you could feed yourself for a lifetime from the markets. Okay, it doesn't matter what any other kind of business you're in, anything you're doing. When you're receiving an income from either the markets or someplace else, you could trade it and create your own cash flow. That's the beauty of what we're teaching right now. And we do that every day. So you have your A to B, C to D. So you're looking for price relationships, equality between here and here. Also what we call an alternate wave equality. That's all it is. Alternate wave equality, where the market trades from high to low, from point A to point B, and then from C to D with the roughly, okay, how do I get it? With roughly the same length. All right. Now, if we take this, I got my dot there. Okay. Now, if we look at this in terms of an Elliott wave, all right, which we're not, and you say, okay, how does the structure really work? If we're looking at higher highs and higher lows also, here's your low, here's your high, here's your low, here's your high, here's your higher high, right? Here's your higher low, and here's your higher high. Now, I want to take it one step further. In the Dow theory, which we'll get to at some point, I'm going to go more into trend in the future. What it does also say is you have these higher highs and higher lows. Those are intermediate type of swings, and within that you have minor waves. So within the larger trend, you have smaller trends also making their higher highs, higher lows. So if you're looking at it, you're saying to yourself, okay, from here we should trend up, and you're still looking at these little trends, opportunities, all right? And then when you do get that pullback, you can relate it to the last largest one, which is this. Something we look at all the time. It's a lot of traders look at this when we're looking at Elliott wave, when we're looking at retracements. Those of you that like to look at Fibonacci, you take your low, you take your high, you put a retracement. Let's just say it's a 38% retracement, okay, for those of you that like Fibonacci. So if you start looking at a retracement zone plus your commonality zone of your price relationship, you start to work and develop yourself an area that you could feel confident that when the market gets there, you could buy it, okay? And you know where you could put your risk points. Let's go to the next slide. Here's another one. As we discussed, here's a high, here's a low, here's a lower high, and we got that process of the trend down, right? Now we want to start looking at, and here's your little minor waves. Now we start looking at relationships of how to identify areas that you would look at as a trader, what are most important. Yes, it's great to say, yes, Chris, you know, higher highs, higher lows, but where do you buy? Where do you sell? All right. So if you were trading this, and even if it went here, you may not have a complete signal because you didn't really have a relationship or a spot to watch. The only thing you could think of is maybe risk here if you're shorting here. Shorting means you want to buy it high and sell it lower and make a profit. Going long means you buy it low and you sell it high to make a profit. So what traders do is they like to look at these commonality zones where from A to B, and I can't see exactly this, let's just say this was 10 points, and you have a 10-point retracement here for C to D, you could feel comfortable that this is a very good area to watch, and you could put your risk quite a bit higher and feel safe that once you enter, you have higher odds to win than you would to fail. Not everything is perfect. You're not going to win every time. There's times you're going to get in, you enter, and you exit at the same price, or you may lose a tick, or you may gain a tick. But if you're identifying very good opportunities, very good zones, then you can feel more comfortable of a larger move. And that's what trading is, really. You're looking at something, you may enter here, you may get out. You may enter here, you may exit, you may enter here, you exit. It may go against you, stop you out, or may continue, but you're looking at the best areas, and in this case, that's why traders like to look at the A to B, C to D relationships, because if it went here, the last time the largest move was 10 points in a downtrending market, more odds than not, if it goes 10 points, that it's going to exhaust itself, that it's found 100% of that prior move, and that's what we call price relationships. Okay, so it looks something like this. If we draw it out, okay, A to B, C to D. This is what we call an alt bullish. Okay, because on the D area you'd look to buy, so that's an alternate bullish. A bearish, it would look something like this. Like you do here. You see this? The same thing. You have your A, B, C, D, and you have your alternate bearish. That right there, this is an alternate bearish because you're looking to sell it to go lower. We have two types of waves, and this is one of them. This is the price relationships, the alternate wave equality, however you like to call it. That's what we call it, an alt bearish and an alt bullish, or an A to B, C to D. They all basically mean the same thing. And I always say you're always looking for D. You're always looking for D. If you're watching the live trading room during the course of the trading day, and we have a nice volatile market. The market started to pick up this week, which is nice. Now you're starting to get the patterns, and you'll start seeing a lot of these type of patterns just occur. Nice. That's what you look for, and that's where the money's made. You may go for days where you're doing a scratch, a scratch, a scratch, plus one tick, minus one tick, and then you'll get 5 points and 3 points, and then a scratch, scratch, 8 points and 2 points. That's how the market works. You wait for the patterns, you look for the spots, and when they occur, bang, you jump all over it. Okay, but sometimes it just you have to scratch it a little bit, meaning you're getting out in and out at the same price, plus or minus, and you're just always identifying spots to work with. As soon as it kicks for you, then you know you got the bull by the horns, because you know that this is a very, very key area. So I'm just trying to stress that the price relationships are really important. Here's another one. We look at this range right here. The market sold off, but if you take a look at the past, you can line up the equality of an A to B, C to D. Now, does this mean you're going to buy it? Does it mean you're going to sell it? No, you can just be monitoring the market and feeling that, you know, if the market's trading lower, you could say to yourself, well, does this market feel like it wants to go a lot lower? Does it feel like a price relationship? If it loses this area, how far to the downside? But you can monitor spots that equate to prior swings. Okay, and you could draw your lines across there, and that's typically a lot of things that we do when we look at the markets. All this other stuff in between is kind of noise. Now, let's just look at something here. Okay, right here, we could just see, all right, you could just see almost that same type of equality. All right, how about this? This little swing here and that swing, almost literally about the same. You see that? So that would be considered an A to B, C to D, and that's an alt bullish. Remember? Down, up, down, what they call an alt bullish. So we've learned today so far is, number one, we learned what a trend is, both an uptrend and a downtrend. We learned what a trading range is, and we learned what price relationships are. So we've learned the basics, the basic fundamentals of technical analysis: trend, trading range, and price relationships. Because if we look at prior swings and we go all the way back, wow, I didn't know the ink stays there. Okay, let's just stop right here. Now let's look at this once again, and the market goes up and the market comes down, eventually starting that process of the higher highs, higher lows, right? And then it comes down right here, and as a trader you look at it and say, wow, that's an A to B, C to D relationship. Let's okay, that would be an alt bullish A to B, C to D relationship. Right, so it doesn't matter where in the structure it is as long as it eventually happens. I'm sure at some point this one and this one have some type of a relationship, but I'm not going to go count it right now. But you could just see by eye that this one right here and this one right here, these swings were nearly identical. And price likes to relate in degree of trend. All right, price likes to relate in degree of trend. So, which means here's your daily chart. It's a very high time frame, and it's relating in that degree in that time frame. Now, for those of you that are already trading, that understand what I'm doing, keep in mind when you trade, when you go from, say, 1360 and the market has come down 10%, let's just say 10%, okay? Come down 1%. How about 1%? It comes down 13.80. It's up here. When it comes down 1%, it's $15 or $15.80. So if you have a market that went 20 points, for instance, here, say it moved 20 points, not necessarily on these larger time frame that 20 points will relate. What you have to look at also is percentage that the market retraced. So if it's traced at a real low price down here and it's moved so far up, you look at this in a percentage basis, not in a points basis. So for those of you that are traders, just something to keep an eye on and make a note of. But those of you that are not trading yet or watching the signal or just learning, don't worry about it. Okay, here again, this has actually happened just recently. We had the market all-time high and then made a low. Then the market made a lower high and a lower low, but it's not defining that downtrend. What would have defined the downtrend if this put a lower high and failed? That would establish the trend going from down to up. But in this case, the trend is where? Low, high, and then you have this A to B, C to D. It's funny, I say high. We have a guy who works with us. He does some graphics, and you get him on Skype, and he goes, "Hi, hello." So I say hi. I think of this guy. Imagine speaking to this guy 11 o'clock at night. Hello. So hi. So we have an A to B, C to D relationship, and in the Elliott wave world, that would also be considered a high, an A, B, C. So although it still has an alternate A to B, C to D, it has a different structure, a different name to it. There's a couple different names you could put, but it's the same thing. All right. But most important, these price structures end up being the same length. So here's a trick also. The market was going sideways for so long, and then it broke to the downside. It gives you that feeling that the market wants to crash and all of a sudden spikes back up. So when you're dealing with these much higher time frames, you have to have a little bit of respect for it also. All right, and we were looking at some other areas when we were watching this on the opening plate video that we put out every day. So if you haven't been watching that, very good idea to watch it. It tells you levels that we're paying attention to. So now we know what a trend is, we know what a range is, we